Quick question before we start, and it is not rhetorical. Every trade has two people in it. You and whoever took the opposite side on purpose. You will spend this whole lesson meeting them. Most traders never do, and it quietly costs them. Let's get into it. Here's a question, and I want you to actually answer it before we start. Every time you buy, at that exact second, someone is selling to you. And very often, it is a professional desk or an algorithm that is genuinely happy to take your order. Not nervous, happy. So why would a pro be glad to be on the other side of your trade? Hold your answer. By the end of this, you will know who is in that chair and the one reason the spread you pay even exists. Let me show you the table. In about 10 minutes, you will stop thinking, I am buying an asset, and start thinking, I am taking one side of an exchange against someone specific. And you will understand why the spread is not just a fee. It is compensation for a risk created by information.
Okay, but here is how I actually think about it. I press buy, I get Bitcoin. I am betting Bitcoin goes up. The other side is just the market, some faceless pool. It does not really matter who, right? I am betting on the asset.
That is the honest, sensible version of the belief, and it deserves credit. Because for a lot of your trades, it is harmless. On a deep, liquid market, you press buy, you get filled near the quote, and the world works. The plumbing is so good, you never have to think about who is on the other end. So why should you care who it is? Because I am betting on the asset hides what you are actually doing. A trade happens because two sides are willing to exchange now, at this price, for different reasons. Sometimes that difference is opinion. Sometimes it is urgency. Sometimes it is cost, speed, inventory, or information. You are not only buying Bitcoin. You are choosing to trade now, at this price, against a counterparty with their own reason, cost structure, and information. The moment that counterparty knows more than you, I am just buying the asset, is the most expensive sentence in trading. Let me open the table. You saw the seats at the top. Commit before I explain. When you fire a plain market order to buy, who is most likely sitting in the chair that fills you? Another regular trader like you? Or a professional whose whole job is to be there? Say it out loud.
My gut says another person like me on the other side. But my gut is usually the booby prize in this series, so a professional? Why would a pro want my random little order?
Often, especially in deep electronic markets, it is a professional liquidity provider. Not always, and not in every venue, but often enough that you should understand why they are there. And the answer to why would they want it is the whole lesson. Here is the table. Sit down in the empty chair. That is you. Now meet the regulars. This seat is a market maker. Their business is quoting a price to buy and a price to sell all day on millions of orders. This one is an HFT, a high-frequency firm whose edge is raw speed. They see and react in microseconds. This one is a fund algo, rebalancing a portfolio with better data and lower costs than you will ever have. And this one is you, clicking once on a laptop, paying retail fees. Often, you are the least resource seat at the table. That does not make you stupid. It means the game has structure before you even click. And notice, their edges are structural, not magic. Speed. They act before the quote moves. Fees. They pay a fraction of what you pay, so a trade that loses you money can make them money. Data. Depending on the venue and business model, some firms see patterns in flow, routing, quotes, cancellations, and execution demand that a retail trader never sees. None of that is them being smarter than you in some cosmic sense. It is them being better resourced for this one game.
Okay, but the market maker thing confuses me. If they will sell to anyone who wants to buy and buy from anyone who wants to sell, are they not just a vending machine? How does a vending machine that does not predict anything make money?
Beautiful question, and that is the door into the real mechanism. The market maker does not predict Bitcoin. They quote two prices, a bid a touch below the middle and an ask a touch above, and they earn that gap, the spread, on enormous volume. They are happy to fill you because your need to trade right now is their revenue. But here's the trap that almost everyone misses, and it is the point of this whole lesson. That little spread is not just a service fee. It is the price of a risk. Let me show you the risk. The market maker stands in the middle, offering to trade with anyone. But anyone is two very different kinds of people. Most who hit their quote are noise. Someone selling for rent, an algo trimming risk, a person who just wants out. The maker prefers that flow because it is less likely to know something urgent. Across enough trades, some buys and sells offset, and the spread helps pay for inventory risk, costs, and the losses from informed traders. But some of the people hitting that quote know something the maker does not yet know. When that informed trader buys, it is because they believe, correctly often enough, that the price is about to move, and the maker just sold to them cheap a moment before the move. So the maker wins against the random people and loses against the few who know things. And now the killer step. The maker cannot tell, at the instant of the trade, which kind you are. Your order and the informed order look identical on the way in. So what does the maker do? They cannot perfectly identify the informed trader before the fill. So they protect themselves the way the market allows. They raise the price of trading for everyone a little, widening the spread when the flow gets more toxic, to cover the losses they take from the few who know more. That widening is called adverse selection. The spread you pay on a totally innocent order exists because somewhere in the flow there is someone who is informed, and the maker has to charge the whole crowd for the risk of meeting them.
Wait, so I pay extra because of strangers I will never meet who might know something?
You pay for the possibility of them. That is the half almost no one explains. The spread is not the maker being greedy. It is the maker pricing in the chance that the next person through the door is smarter than they are. The more informed flow there is in a market, the wider that spread has to be just to keep the lights on. Laurent Bernoux makes exactly this point about information asymmetry. The other side of your trade often knows more, and the structure of the market is built around that fact, not around fairness. Same maker, same code. When almost everyone is noise, the maker survives on a hair-thin spread. Turn up the share of informed traders, and the identical maker has to charge nearly 8 times as wide just to break even. Nobody got greedier. The risk of trading against someone who knows more went up, so the price of trading went up, for all of us. That is adverse selection in one number. This happens in both markets, and it is worth being precise about who wins. Worked first, crypto. You buy BTC on a deep venue. A market maker fills you instantly at a good price and pockets the spread. This worked for both of you. You got your fill, the maker got paid for standing there ready, and crucially, the maker did not need a big directional view on Bitcoin at all. Their business was managing spread, inventory, hedging, and flow across many trades. The system did its job. The maker is happy because you were almost certainly noise, not informed, and noise is exactly the customer they want. So where does it break for you? It breaks in the sense that the edge is structural and it is not yours, in equities. In US stock markets, a large share of retail orders never touch the public exchange at all. Your broker routes them to a wholesale market maker who pays the broker for that flow, payment for order flow, and fills you internally. Why would a wholesaler pay to get your order? Because retail flow is, on average, the good kind, mostly noise, rarely informed. They are paying for the privilege of trading against the least informed pool in the market. That does not automatically mean the trade is bad, and it does not automatically mean the system is fair. It means retail flow has value because it is usually less informed, and different firms compete to interact with it under a specific market structure model. And the why is adverse selection, every time. The maker earns the spread off the noise and uses it to survive the informed. Retail flow is valuable precisely because it is unlikely to be the informed side, so it is the safest flow to trade against, and people will pay for it. Flip it around and you have the uncomfortable mirror. If professionals are consistently happy to trade with a flow category, that tells you something about the category. It usually means that, on average, the flow is less informed than the counterparties competing to trade against it. Which is exactly why this series never hands you a confident, the price says buy. A confident call is what an informed trader has. What you and I usually have is a distribution, a range of what historically happened next, with the honest admission that we are probably not the smartest seat at the table. Let me make that concrete with the strangest month markets have had in decades, because this exact structure was on every front page and almost nobody described it. January 2021. A struggling mall retailer called GameStop becomes the center of the financial internet. This is what it looks like when a crowded short meets a crowd online. Start with the setup. Going in, the stock was heavily shorted. A lot of professional money was positioned for it to keep falling, all leaning the same way. Crowding like that is its own kind of risk, because when everyone is on one side, a move against them can turn into a reflex. Then the ignition. Millions of retail traders, a lot of them on one Reddit forum, pile into the stock, partly as a trade, partly, honestly, as a crusade against the hedge funds shorting it. The story moved first, then the orders did. And the pressure fed on itself. The reported numbers are absurd. The stock goes from under $20 to a reported intraday high near $500 in about 2 weeks. Buying forced covering, and covering forced more buying. A squeeze is a feedback loop. Then the system hit its limits. Broker apps buckle under the volume. New accounts open by the million. When stress arrives like that, the plumbing nobody thinks about is suddenly the whole story. And here's the detail almost everyone missed, the one this lesson is about. This was never just one stock. Those millions of orders, the famous free trades, mostly never touched a public exchange at all. They were routed, order by order, to a handful of wholesale market makers who paid the brokers for them. Payment for order flow. The exact plumbing we just drew, carrying the loudest trade in the world.
Hold on. The most famous retail trading frenzy in a generation. And most of those orders never even reached the exchange?
By the reported figures at the time, a very large share did not. So ask today's question about it. Who was on the other side, and how did they feel about being there? The wholesalers were on the other side, and they wanted to be, badly. Not because they knew where GameStop was going. Nobody knew that, and some professionals got badly hurt guessing. They wanted that flood because it was retail flow at record scale. Small, excited, and on average uninformed. Exactly the flow a maker can safely stand across from in both directions, earning the spread on every fill. Reportedly, standing calmly in the middle of that storm gave some of those desks among the busiest and most profitable stretches they had ever had. Now, I am not going to tell you who was right in that fight. That is still argued about, and it is not the lesson. The lesson is the structure underneath the drama. Millions of people believed they were storming the exchange. Structurally, most of their clicks went to a quiet desk that had paid for the privilege of being their counterparty, precisely because that flow was, on average, the safest in the market to trade against. Someone specific was on the other side of every one of those trades, and they were happy to be there. Warren Buffett folded this whole lesson into one line long ago in his 1987 letter to shareholders. As they say in poker, if you've been in the game 30 minutes and you do not know who the patsy is, you are the patsy. Read it kindly because it is not an insult. It is an instruction. It hands you the one question to ask before you sit down, not after. And unlike the poker table, you now know how to reason about the answer. Lock it in. Not what is the spread? Why does it exist at all? Why does an innocent order pay it?
Because the maker cannot tell before the trade whether this order is harmless or informed. So they charge a spread to everyone?
Exactly. The spread is the price of not knowing who just walked through the door. You now understand adverse selection better than most people who have paid that spread 10,000 times. So carry one thing out of this room. Call it the table test. Before you trust your edge on any single trade, ask who is on the other side and what they know that you do not. If you cannot answer that, you are not reading the market. You are reading yourself. 2 things before you go, and both test whether today landed. First, a question. If market makers earn the spread mostly from noise traders, why can they not just quote a spread of 0 and win every trade on volume? Answer in one sentence, and the key idea should be adverse selection. Second, for anyone who wants to get their hands dirty, here is a challenge. Take the market maker spread simulation I just ran and raise the informed fraction gradually, watching for the moment the break-even spread stops its slow creep and suddenly bolts upward. Post your code, a gist, or a screenshot. I read the comments and I answer there. And to be clear what we do here, we show you how to reason about who is across the table and why, never what to do with a position. We teach the thinking. The decision is always yours. There is an old line about poker that is even truer here. Before you play the hand, know the table. What sets the seat across from you apart is not magic. It is structure, speed, fees, data, and the quiet logic of adverse selection that prices a stranger's knowledge into the cost you pay. So know who is across from you, what they can see, and what you cannot. Next time, we ask the question underneath all of this. Why do prices move at all? And you will see that the honest answer is messier than any headline. So before your next trade, ask who is across the table from you. That habit alone will change how you see the market. Next time, we go one level deeper. Why do prices move at all? Subscribe so the next one finds you, and I will see you there.